Yariv and Eyal and I do a fair amount of transfer pricing work together for U.S. and Israeli-based groups. They've asked me to come and speak a little bit about U.S. transfer pricing rules, specifically our Code Section 482, which I'm sure you've heard about, and our 6662, the documentation and penalty provisions in our code. Code Section 482 gives the IRS very, very broad powers to allocate income, deductions, and credits between two or among two organizations. So in the previous slide, it has the ability to reallocate income between limited and Inc. or Inc. and limited, between or among two organizations, trades, or businesses owned or controlled by the same interest in order to prevent the evasion of U.S. taxes or clearly to reflect income of a controlled taxpayer. So if we go back here, where Inc. owns 100% of limited, you'd say, well, what does the U.S. government have to care about limited's taxable income? And I'll tell you what it has. It has everything to do with earnings and profits. In the United States, we look at our foreign subsidiaries and we say, what are the earnings and profits of that entity? Because it's earnings and profits that will determine whether that subsidiary can pay a dividend to the United States. Earnings and profits are calculated on taxable income. If taxable income is wrong, then earnings and profits are wrong, and therefore we don't know whether we have a dividend or we don't have a dividend. That's why the government can tell limited what its taxable income should be from a U.S. point of view. As Yariv must have said, and as you all know, the whole idea behind Code Section 482 is to have Inc. and limited act as if they're unrelated parties. That is, they service each other on an arm's length basis. So when limited sells its services to Inc. or Inc. sells its services to limited, it's as if they're dealing with a third party, and they would ask each other what a third party would pay for those services. Regardless of what the accounting books and records of a taxpayer may be, the U.S. 482 regulations require that when the taxpayer files its U.S. tax return, that the P&L is adjusted to reflect arm's length results. So the U.S. gives, if you will, the taxpayer the right to adjust its books for tax purposes to reflect arm's length pricing. That is the only right, if you will, that the IRS gives taxpayers, U.S. taxpayers, to effect 482 adjustments. Everything else with respect to 482 is with the government. The adjustments, the allocations, the penalties, all with the government. The government very much believes that 482 and 6662 is a one-way street, all in favor of the government. You cannot, the important thing here is, should you want to decrease taxable income because you got your transfer pricing wrong, let's say, for example, Inc. is a cost-plus service provider. It's a cost-plus marketer. And let's say Inc. was charging limited cost plus 8%. And we hire Yariv and Eyal and say, what should we have, as a U.S. distributor, what should my markup have been? And Eyal and Yariv come back and they say, it should have been cost plus 2%. I cannot, as a U.S. taxpayer, amend my return to decrease my taxable income. I have to get it right in the first instance with my original return. So 482 provides the operating rules. 6662 is the penalty provisions. If you get it wrong, it's 6662 that gives the government the right to impose a penalty. As with sale of tangible property, the sale and leasing of intangible property, the final regs provide that an arm's length amount charged in a controlled services transaction must be determined under one of the prescribed methods. So if we're talking about services, there's a set of prescribed pricing methods. If we're talking about tangible property, there's another set of prescribed methods, and they're similar. Each method must be applied in accordance with the best method rule. I think I heard Yariv mention the best method rule. I can't remember what the OECD counterpart is to the best method. What the reasonable method?
Reasonable for now and maybe appropriate for.
I love that. I love that. Couldn't just say best method.
No, I told them that they want to not from the Americans.
Not completely, at least. The comparability analysis, and then the arm's length range, and I believe Yariv spoke to all of those. These are the pricing methods that are listed in the services regs, and we'll talk a little bit about the services cost method because that's of great interest. The comparable uncontrolled services price method, the gross margin method, cost of services plus method. Yariv and I've used that together on management services. CPM, very, very popular, and the profit split. Okay, so the great thing about the services cost method is if you get inside these rules, you're able to provide the services either Inc. to limited or limited to Inc. at cost with no markup. So again, the great thing about the services cost method is if you can fit yourself within the rules, and it's not so easy, but if you can, the services can go back and forth at cost with no markup and no adjustment by the government. In summary, the way I look at transfer pricing is it's sort of a holistic thing. You first have to figure out, let's assume you have, again, limited at the top and the U.S. a wholly owned subsidiary. The first thing you have to figure out is what is the legal relationship between those two entities? Is the U.S. going to be a cost plus service provider to limited, or is limited going to make its IP available to the U.S. and say, U.S., here's the highly valuable IP. You go and do what you can in your marketplace as an entrepreneur. So that first has to be decided. What the legal relationship is going to be between the parent and the sub, whether it be Israel on the top or the U.S. at the top. Once that's been decided, then you hire Yariv and Eyal to say, okay, this is the pricing, this is the range of acceptable pricing on those services that are being provided on those legal relationships. Once the pricing has been established, then you need to get a formal intercompany agreement in place that not only reflects very clearly the desired legal relationship, but also the pricing that Yariv and Eyal have told us it should be. And then finally, make sure that the U.S. tax returns that are being filed that include the services or sales or whatever properly reflect what the transfer pricing and the intercompany agreement tell us they should. And again, remember, if it's an increase in taxable income, that has to be on the original return. If it's a decrease, it can be on an amended return. That's all I have. Is there any questions?